Einstein of Wall Street.
Yes.
There are relief rallies, and then there are 2.9% relief rallies. What's going on today?
This is a mixture of a relief rally, and obviously, even though, we're running on the news that Iran said that they are prepared to end the war. Is that real? I don't know, but we were way oversold short term. Look, if this all changes tomorrow and the war's not over, we could go right back down to where we were. But basically, the market was dying for something to grab a hold of, and that was enough of a news brief. We came in, this morning, we were already on the way up. Yesterday was, maybe in retrospect, maybe yesterday was some kind of a capitulation on everything, that we broke down, because if you remember, over the weekend, we were actually down on Sunday night.
Oh, yeah.
And we came in and opened up Monday morning, but we absolutely caved in after the open. So yesterday was the beginning of it. Today's a bit of a follow-through. I'm hoping this continues.
Yeah, we'll see what
but
happens.
We need a lot of these.
Yeah, today's the final day of the quarter as well. A bit of a rebound. Fresh money maybe entering for the start of Q2 tomorrow.
Absolutely.
Things there. Thanks for being here to kick things
Always
off.
a pleasure.
We'll talk to you in a bit. The great Caleb Silver's on deck. He'll join us right after the bell. The team from Dimensional on the broadcast and set to ring in the closing bell. Time now for the close. And there you have it, your final tail of the tape on this Tuesday, March 31st, the final trading day of the month, the final trading day of Q1. You could do this job for many years, and you look up and you don't frequently see days that are quite this strong. This relief rally, after reaching oversold conditions yesterday and the days leading up to yesterday's session, your final tail of the tape on this final trading day of March. Remarkable. The S&P 500 up 2.9%, the Dow 30 up 2.5%, the New York Stock Exchange Composite Index in positive territory, 2.3%, and how about the small caps, up 3.4% on the day. All Mag 7 names in positive territory, tech, discretionary, and industrials. Those are your strongest performing S&P sectors, but a downward pressure for energy and utilities, really seeing that risk-on rotation back in full force. Let's bring in the man himself, Caleb Silver, editor-in-chief at Investopedia. My man, great to have you here. And for all the times you and I have done this, I say we don't look up and quite see this style board more broadly. What are you seeing in these markets? Quite the rally today.
Yeah, are you not entertained? This is as big a relief rally as we've seen in a long time. Again, as Peter just said, oversold turns into overbought real quick these days, and we're seeing an individual rally, broad-based across sectors, except for energy and defense, which have been the leaders. Yep. But if you look at semis had a huge day on semiconductor, up 12%. Looking at other semiconductor stocks, up 11, 10%, and you wonder why individual investors have a hard time selling their favorite stocks. You get a 6% rally in a stock like NVIDIA today. Hard to let go, because when the relief rally comes, it comes for the big stocks first.
Yeah, we're taking a look right now. You and I at semiconductors, we're seeing Intel up 7%, Broadcom, AVGO up 5.5%. We are entering, if we take it a step back from this day or this week, historically the weak part of the 4-year cycle, especially as we hit kind of this weird spot of Q2 in a midterm election year. What does history tell us, and how are day-to-day investors preparing for the road ahead?
Yeah, not to be Chicken Little this far away from Thanksgiving, but these are the worst 2 months typically of a midterm election year. It gets chaotic, and it's been nothing but chaotic for the first quarter, so expect more volatility. If it wasn't this geopolitical event and the war in Iran, it might be something else. There's going to be a lot more headlines. Individual investors have remained pretty resilient, though. Not a lot of dip buying, as we've seen in other cycles because of the unpredictability of oil prices, but still hanging in there with their allocations and doing some buying outside of the defined contribution plans as well.
I want to get your sense on what are among the most popular names. As you and I have had these conversations over the years, we see that retail investors, they gravitate to the NVIDIAs of the world, the Microsofts of the world. They had a very strong session today, but they've really been beaten down year to date. Are those still the strongest, most popular names that day-to-day investors are keeping their eyes on?
Yeah, and if you look across the different ways that we track this, whether it's VandeTrack or some of the other trackers, you see that it's the big stocks. It's obviously NVIDIA. Tesla still has a huge fan base that wants to buy the dip. Wow. That stock's down 20%. It's on sale for those investors right now, as usual. But a lot of the semi stocks that have been beaten down, and the software stocks, they're getting a bid from individual investors. But they stay faithful to the home cooking, the stocks that brought them these great returns over the last 3 years. I don't expect that to change.
I know day-to-day readers of Investopedia, they're flocking to it as an outstanding resource to learn things like Backwardation. What is top of mind? Why are people looking up that term right now?
That's exactly what we're seeing in the oil market right now. Remember, oil, like all commodities, trades on the futures market, but also the spot price. When the spot price, the price you pay for oil delivery today, is higher than the future prices, that's what we call backwardation. The opposite is contango. No, not a beautiful city in the River Plate or a dance, but that's the normal state of commodities where you'll pay less today but more in the future because of storage costs. That's not what's happening, and that tells you that oil traders at least believe that this war in Iran will not last very long.
And when will last? Well, I still got some time. Fibonacci retracement. We know that from our friends in the CMT Association. Interesting to see those technical analysis tools work their way onto the computer desktops of retail investors. Seems like they're trying to learn a lot more about at least the technical side of
Yeah,
things.
who would have thought that an Italian mathematician from the Dark Ages would make an appearance in today's chaotic, volatile markets? But the Fibonacci retracement shows where technical analysis think the next level down might have been for the S&P 500, and it was down about 9% from Friday's close. So they were thinking if it continued to fall, it had another 9% to go before it hit that retracement level. The Fibonacci sequence, of course, famous for the rabbits. We had that big relief rally today. That changes the calculus. The math needs to look a lot differently right now, but the relief rally did relieve some pressure in the markets.
Caleb Silver, EIC and Investopedia, my man. Thanks for being here to kick off the show. Nice to have you.
Thanks,
Skylar, grab your mic. Jeff, you and I will head this way for a walk. Bringing the latest analyst calls that hit the tape early this morning. Moving markets, Loop initiating, excuse me. Visa and MasterCard both as buys. They say both credit card giants are well positioned. Bernstein next up, upgrading Western Digital to outperform. That's been one of these absolutely parabolic memory stocks as of late. They say it has had a little bit of downward pressure. That recent sell-off, excuse me, Sarah, I'm going to come to your right, thank you, provides an attractive entry point. Finally, Citi reiterating Micron as a buy, but lowering its price target down to $425. We'll take a look at one notable before we toss the break. How about Shake Shack, up almost 6% on the day. B of A upgrading the stock to neutral from underperform. They say we see several positive catalysts in the months ahead, including menu innovation, more stable same-store sales traffic, despite macro concerns. Shares of Shake Shack up about 1 to 2% so far here in 2026. In partnership with Equinox Gold, we now bring you a conversation between FinTech TV's lead anchor, Remy Blair, and Equinox Gold Executive Vice President of Capital Markets, Ryan King. Take a look.
Welcome to FinTech TV. I'm Remy Blair. Gold remains in the spotlight with investors looking for companies that can turn high prices into real profit and also returns for shareholders. In 2025, Equinox Gold saw a massive transition year. They completed a major merger with Calibre, transforming the company into a top-tier North American-focused gold producer anchored by 2 brand new long-life mines in Canada, and just released preliminary results for the fourth quarter and full year of 2025 shows a dramatic turnaround, and they paid down a staggering $1.1 billion in debt since the second quarter. They just announced their first ever quarterly cash dividend for shareholders alongside a share buyback program. Well, joining me live at the New York Stock Exchange is Ryan King, Executive VP of Capital Markets at Equinox Gold Corp. Thank you so much for joining me today.
Oh, thank you for the time.
Well, first and foremost, tell us about Equinox Gold and also the merger with Calibre.
Yeah, so Equinox Gold is a diversified gold producer. And the merger with Calibre was very interesting. It brought together 2 high quality teams. And we were just talking off air about Ross Beatty, the founder of Equinox Gold. He's been involved in many very significant finds in terms of Pan American Silver and other companies. So Ross started this company a few years ago, and by bringing these 2 teams together, we were able to strengthen the management team, but also more importantly, we were able to bring together 2 high quality Canadian gold assets that were just ramping up. So we're in the process of a significant transformation there, with upwards of to 500,000 ounces of annual gold production coming out of Canada, and that's what investors look for: tier 1 jurisdictional assets, and we're turning up 2 tier 1 jurisdictional assets. So it's an exciting time.
Yes, and as 2026 gets underway, we know that all eyes have been on the precious metals, in particular gold and silver prices. And you just mentioned management, and that is so key when we're talking about organizational management. So give us an idea of what actually resulted in these stellar results you saw last year.
Well, the deal closed in June, and so we reset the market's expectation in terms of guidance for the year. In July of last year, a few management changes happened. So the CEO change happened, and where the Caliber Mining CEO Darren Hall became CEO of the new Equinox Gold. And the new Equinox is really about operational focus now, with these turn up of these big, key, large open pit mines. And Darren brings a tremendous amount of experience. He was at Newmont for over 30 years, and his role there was optimizing assets, big open pit mines. And now with this transition, less about mergers and acquisitions and more about focus on operational execution. And so that was a pivotal moment, I think, for shareholders of both companies and shareholders looking at the new company going forward. But what happened last year was we have an asset called the Valentine Gold Mine. It's located in the central region of Newfoundland. And that asset, we completed construction in about August. We had first gold in September, and then we turned that into commercial production by November. So that was a pretty significant inflection point for anyone going from investing to harvesting cash flow. And that asset is currently ramping up this year. And also importantly, we saw some pretty significant changes with what we call the Greenstone mine. This is a very large open pit mine in northern Ontario. And because of some of the work that Darren and his technical team were able to do, we were able to ramp up production quite significantly in the second half of last year. In fact, Q4, we had a record quarter out of Greenstone. Produced over 72,000 ounces of gold. So we're very excited about the year ahead of us now. Between those two assets, 150,000 to 200,000 ounces at Valentine this year's our guidance, and then 250 to 300,000 ounces at Greenstone. So we believe there's a tremendous opportunity here. And then we look at the business, and it's less about those ramp ups and more about just being boring, which is kind of interesting. Boring, delivering into expectations. So that's what led to a lot of that transformation last year. But there's also a lot of excitement going into 2026.
And speaking of that and opportunity alongside being boring, I understand that you have eliminated over $1 billion in debt, and that is significant. So tell us what we can expect heading into 2026.
Sure. Uh, yeah, we were about 1.6 billion net debt when we closed the deal with Caliber. Um, Now today, as you just mentioned, we've got about we're probably today probably net cash neutral, which is pretty phenomenal to say. We've divested of some assets, which helped us pay down debt. The operating cash flow from the end of last year helped us pay down more debt. So now today, we've got about a little under $500 million of a revolving credit facility that's been drawn, but we also have about $500 million of cash. So when we look ahead to 2026, in total, we're guiding the market 700 to 800,000 ounces of gold production, with, as we've just talked about, gold trading over $5,000 an ounce. With the company's all-in sustaining costs, I think our guidance is 1,775 to 1,875. So a tremendous margin. So with that, we're able to pay down even more debt. And we would anticipate that by the end of Q3, maybe Q4, we should be debt free and have about an $850 million revolving credit facility available to us, because the company does have very interesting growth in front of us.
Well, Ryan, I appreciate your time. Thank you so much for joining us here at the New York Stock Exchange. And thank you so much for sharing the origin of the company.
Excellent to be here. Thank you for your
Thank
time.
you.
Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange, and Ken Hullings joins us now. He is the Executive Vice President of Client Success at LPL Financial. Welcome down to the big board. Really nice to have you.
Yeah, thank you so much. This is fun.
So let's talk all about the LPL Institutional Benchmark Report. This is a lot of data. 1,200 institutions, 7,400 different advisors. How is that group, that tranche, these institutions approaching the wealth management space right now?
Yeah, so wealth management is really important for financial institutions. If it's done well, a financial institution becomes indispensable to their customers. So the ones that we see leading the pack are really focused on four things: winning the race for talent, expanding and deepening their existing client relationships, enhancing efficiency by boosting capabilities and capacity, and finally evolving their business model.
And evolving their business model. What are some of the trends that you think are most concerning to institutions right now in this particular ecosystem, this environment? We got no shortage of uncertainty right now, Ken.
Uncertainty is here, for sure. The things executives are thinking about that are running wealth management businesses at institutions are really focused on, hey, is my business set up to be sustainable? Many of the institutions are growing year over year, but a lot of it is because of market tailwinds, which is obviously potentially changing over the last couple months, as well as inorganic activity, M&A and advisor recruitment. So am I setting myself up for sustainable growth? Second, do I have the right processes and procedures in place to make sure I'm supporting advisors and their clients in a really challenging competitive talent market? And then finally, you know as well as I do, we have this great generational transfer of wealth. If I am not capturing that transfer of wealth right now, I am funding the growth of my competitors. So those are the things that are on the minds of top executives.
Can you talk to me a bit more about the recruitment strategy out there with no shortage of options for a lot of this top talent to go to? How are they going about attaining and retaining a lot of the top tier talent that they want to represent their firms, their wealth management goals, not just in the short term, but establish those relationships for the long haul?
Yeah, it's a really good question. The amount of advisors in the market is not growing. So you have less supply for these advisors, which means the demand is through the roof, which means it's very competitive. And so in order to attract or retain top advisors, it really comes down to, are you providing a good value prop? Are you providing them the technology they need to grow? Are you providing them the products and platforms that they need? And finally, are you focused on their experience, taking friction out of the ecosystem for them? And then finally, as they go through their career, are you setting yourself up as the place where they want to retire? And they want to pass their client relationships down to the people on their team and to the next generation of advisors.
Correct me if I've got this wrong. More than 100,000 advisors are set
crazy
to retire within the next decade. What does that do for the broader conversation of succession planning?
It's really amazing to think about what that could mean for the industry and for these financial institutions. As it relates to succession planning, again, financial institutions need to make sure that they have a well-defined program that advisors understand, that feels fair to recognize their life's work that they've put in, but also is very seamless to the client relationships, because the client experience is the thing that really matters.
I wonder what in your data, if anything, you've got about AI, either the way that's being used and leveraged by the wealth management funds, or do you have a lot of advisors in the space who say, hey, it may be all well and good to embrace some of these new age tools, but AI may actually be a bit of a threat to our industry? Is that conversation happening at all?
All day, every day, as
Wow.
I'm sure it is with you. And it's less of a threat, it's more of an opportunity right now, mainly because of the capacity need. So in the report, you'll see the average advisor is dealing with 433 clients. Most advisors, especially top performing advisors, serve around 250 or 300. So the advisors are way over capacity. What that means is they're not being able to deepen the relationships as much as they have, and much of their revenue is only coming from a small percentage of their clients. And so if they use AI right, it'll free up a lot of their time to go deeper with their clients, attract more customers, become more valuable to those clients. And again, when this transfer of wealth hits us or continues to hit us, they'll be in such a great position to secure those relationships.
Ken Hullins, Executive Vice President of Client Success at the one and only LPL Financial. Thanks a lot for being down here, and thanks for being on the show.
Thank you so much.
There you go. In the crowd. Look at the crowd. They all came down here for you. Don't go anywhere. A whole lot more Taking Stock coming up live from the big board after this. I said down.
Thanks, man.
Thank you, dude.
Appreciate it.
Let's do it. Welcome back to the show. Our next guest joins us live down here on the trading floor of the New York Stock Exchange. Say hello to Joel Schneider. He is Deputy Head of Portfolio Management at Dimensional Fund Advisors. Really nice to have you. Thanks for being here.
Yeah, pleasure to be here. Thanks
So
for having
I think
us.
to properly give the context of what you're all here to celebrate, we need to go back a few decades. 1981, your first mutual fund. It was a U.S. micro cap portfolio. That's all the way back in 81, and now you've released the Dimensional U.S. Microcap ETF. It's a share class of that original product. Why now?
That's right. So there's two really important things about DFMC, which is the ETF share class of that microcap portfolio. The first is that it is literally the industry's first active ETF that's a share class of a mutual fund. And we think there's a lot of benefits of that share class structure for the end investor. The second thing that people should know is important is that right now, with the market being so top heavy, DFMC gives people the opportunity to get diversification in the US equity market. And in doing that, they don't necessarily have to give up great performance. If you look at the track record of DFMC, it goes back over 4 decades, and it has crushed the small cap benchmark. And so in pursuing that additional diversification that people want, they can still get great performance too.
And is that kind of part of the overall thesis, which is, hey, look at these mega caps, look at these top heavy names. The S&P 500 is disproportionately consolidated around a lot of those big names, and there are some other parts of the market that are worth paying attention to?
Yeah, absolutely. So the origin story of this fund is really important right now because we launched this for institutional investors. And the problem that those institutional investors had was that they were over-concentrated in US large cap stocks.
Yeah.
Interestingly, that was 45 years ago. And so in many ways, history repeats itself.
Yeah.
And so now for investors who are concerned about that concentration, they're thinking about how do I diversify, but in a way where I still get good performance. And this portfolio has a 45-year track record, beaten the benchmark by 150 basis points
Wow.
a year. So I think right now is great timing for this strategy.
And when we talk micro cap, we're talking market cap somewhere between 50 million and 300 million. Is that more or less the range for a lot of these companies
Yeah.
you target?
So we're talking about the bottom half of small cap. So we call small cap the bottom 10% of the market. And if you look out there, there's a bunch of different small cap indexes. They use all sorts of different definitions of small. So there really isn't one definition. A lot of those indices have really big performance differences against each other. And so what we do here is we target the bottom 5% of companies in the US market and get rid of a lot of the underperforming ones. And so that's what drives the outperformance of this relative to other small cap funds.
For a lot of investors who aren't familiar with micros, does activity more or less follow the same pattern we have in the broader S&P 500? In other words, tech and discretionary tend to be much bigger than utilities and real estate. Do the same sorts of assortment there for stocks work for microcap as well, or is the consideration a bit different?
Yeah, so the makeup of the microcap space is different from the large cap space, which is a good thing. This gives you additional diversification. So in a year like this year, where you've seen the S&P isn't up the way that it has been, actually this portfolio has been up 9% versus the S&P 500 this year, and it's because you're accessing different sectors, different industries, and different companies.
That's awesome. Really exciting project. Joel Schneider, Deputy Head of Portfolio Management at Dimensional. Thanks a lot for being here. Congrats on the new launch. Nice to have you.
Yeah, we're excited about it. Thanks for having us.
All right, don't go anywhere. A lot more Taking Stock coming up after this.
Welcome back. I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money, where we celebrate the companies doing the glamorous work, like cleaning financial data. Yes, today's feature is Duco, because even the biggest banks need help tidying their room. Duco builds automated data reconciliation and data quality infrastructure for financial institutions drowning in messy data. And let me tell you, that happens a lot. The messy data, the legacy systems, and regulatory reporting demands. So how does Duco actually make that money? First of all, the SaaS subscriptions for its cloud-based data automation platform. Second, usage-based fees tied to the volume of reconciliations and data checks. Third, enterprise licensing for AI-driven data matching, exemption management, and workflow automation. And fourth, professional services for integrations, custom rules, migration support, and regulatory prep. So let's do that momentum check here for a second. Duco made headlines this month when the founder Christian returned as CEO on March 16th, noting the explosion in AI models requires a safer operational layer for financial institutions. So what is the moat of Duco exactly? It's all about that reliability. When a bank wires its reconciliation and reporting flows through a platform, it does not rip it out lightly. And that is how Duco actually makes money, by turning messy data into something banks can actually use without breaking out in highs. And with that, we're back over to you.
Nike shares are down after reporting quarterly results a few moments ago, currently down 2.5% after the bell. Tomorrow is April Fool's Day, but the markets will be open, which is not a fool. 8:15 ADP jobs report for the month of March will cross the wires. The February retail sales data, March ISM manufacturing, and in the morning earnings from names like Tilray and Conagra Brands. That's going to do it for this March 31st edition of Taking Stock. Have a good night. We'll see you again tomorrow.